What's up everybody, it's Graham Stephan, and today we're diving into the world of index investing. Think of indexes like checking the score of a basketball game. They tell you how the market is doing. Understanding indexes is like having a roadmap to the stock market. They help you make smarter investment decisions. Over the next few chapters, we'll break down 12 key indexes, from the S&P 500 to the Nikkei 225. Get ready to master the world of indexes. Let's get started. First up, we're tackling the big dog, the heavyweight champion of indexes, the S&P 500. This index tracks the performance of 500 of the largest publicly traded companies in the United States. Think Apple, Amazon, Microsoft. These are the companies that make up the S&P 500. Now, why is this index so important? Well, it represents about 80% of the total value of the US stock market. That means when people talk about how the market is doing, they're usually talking about the S&P 500. It's like the benchmark for the entire US economy. And historically speaking, the S&P 500 has been a pretty solid investment. Over the long term, it's delivered an average annual return of around 10%. Of course, past performance is not indicative of future results, but it does show the potential of investing in this index. So, if you're looking for a simple and effective way to invest in the US stock market, the S&P 500 is a great place to start. There are tons of low-cost index funds and ETFs that track the S&P 500, making it super easy to get started. Now, you might be thinking, Graham, I'm not a Wall Street hotshot. Why should I care about the S&P 500? Well, here's the thing. Even if you're not actively picking stocks, the S&P 500 can still impact your financial life. For example, if you have a 401k or an IRA, chances are you already have some exposure to the S&P 500 through mutual funds or target date funds. Understanding how this index works can help you make more informed decisions about your retirement savings. Plus, the S&P 500 is a great indicator of the overall health of the US economy. When the S&P 500 is doing well, it usually means businesses are growing, people are spending money, and the economy is strong. On the flip side, when the S&P 500 takes a dip, it can be a sign of economic trouble. So, whether you're a seasoned investor or just starting out, paying attention to the S&P 500 can give you valuable insights into the market and the economy as a whole. It's like having a finger on the pulse of the financial world. Alright, moving on to another major player in the index game, the NASDAQ Composite. Now this index is known for being tech-heavy, with companies like Apple, Microsoft, Amazon, and Google, all calling the NASDAQ home. So if you're bullish on the future of technology and innovation, the NASDAQ is definitely an index to watch. It's like having a front row seat to the tech revolution with the potential for explosive growth. But remember, with great potential comes greater volatility. The NASDAQ is known for being more volatile than the S&P 500, meaning it can experience bigger swings in price. This can be both a blessing and a curse, offering the potential for bigger gains, but also the risk of larger losses. So, how do you know if investing in the NASDAQ is right for you? Well, it all comes down to your risk tolerance and investment goals. If you're younger and have a longer time horizon, you might be more comfortable with the volatility of the NASDAQ. On the other hand, if you're closer to retirement and looking for more stability, the NASDAQ might not be the best fit. It's all about finding the right balance between risk and reward for your individual situation. But regardless of your investment strategy, understanding the NASDAQ is crucial for any investor. It's a major driver of the global economy, and a key indicator of the tech sector's performance. So whether you're a tech enthusiast or just looking to diversify your portfolio, the NASDAQ is an index you need to know about. It's a wild ride, but it can be incredibly rewarding for those who are prepared. Alright, let's talk about the Dow Jones Industrial Average, or as the cool kids call it, the DJIA. This index has been around since 1896, making it older than sliced bread and even older than your grandpa's investment advice. Now you might be thinking 1896, that's ancient history, and you wouldn't be wrong. Back then, the DJIA only had 12 companies, mostly in industrial sectors like railroads and cotton. Can you imagine? No Tesla, no Apple, no Amazon. But here's the thing, the DJIA has stood the test of time. It's gone through world wars, recessions, and even the dot-com bubble, and it's still here, tracking the US economy. Today, it represents 30 large, publicly owned companies across various industries, giving you a taste of the American corporate landscape. So, while it might not be as flashy as some of the newer indices, the DJIA is a reminder that slow and steady wins the race. It's like that reliable old car you have that just keeps chugging along year after year. One of the key things to remember about the DJIA is that it's price-weighted. This means that companies with higher share prices have a bigger influence on the index's movements. So when a company like Boeing or Goldman Sachs has a good day, the DJIA tends to get a little happier. Now, this is different from other indices like the S&P 500, which are market cap weighted, giving more weight to companies with larger market capitalizations. Both approaches have their pros and cons, but the DJIA's price weighting gives it a unique flavor. Think of it like this. The DJIA is like a carefully curated tasting menu at a fancy restaurant. It only includes a select few blue-chip companies with long track records of success. It's not trying to be everything to everyone, it's about quality over quantity. And let's be real, sometimes you just want a classic, reliable experience. That's what the DJIA offers, a glimpse into the heart of the American economy with a history that speaks for itself. So don't underestimate the OG index, it's still got it. Alright, let's hop across the pond and talk about the FTSE 100, the big cheese of the London Stock Exchange. This index tracks the 100 largest companies listed on the LSE, representing about 80% of its total market capitalization. Think of it like the British version of the S&P 500, but with a slightly more sophisticated accent. Now when you think of the UK, you might picture tea time, double-decker buses, and maybe even the Queen. But don't let that fool you, the FTSE 100 is a global powerhouse. You see, many of the companies listed on the FTSE 100 are multinational corporations with operations all over the world. We're talking big names like HSBC, Unilever, and British American Tobacco. These companies are involved in everything from banking and consumer goods to pharmaceuticals and telecommunications, giving the index a truly global reach. So, while the FTSE 100 might be based in London, its influence extends far beyond the shores of the UK. It's a reminder that in today's interconnected world, investing is no longer confined by geographical borders. Now you might be wondering, what about Brexit? How did that impact the FTSE 100? And it's a valid question. The UK's decision to leave the European Union definitely caused some uncertainty in the markets, and the FTSE 100 wasn't immune to the volatility. However, it's important to remember that the FTSE 100 is a resilient index. It's weathered its fair share of storms in the past, and it always seems to bounce back. Plus, the weaker pound actually benefited many of the multinational companies listed on the index, as their overseas earnings were boosted when converted back into sterling. Think of it like this. The FTSE 100 is like a seasoned sailor who's been through countless storms before. Sure, Brexit might have rocked the boat a bit, but the sailor knows how to navigate choppy waters and come out stronger on the other side. So, if you're looking for exposure to the UK market and beyond, the FTSE 100 is definitely worth considering. It's a well-established index with a global reach and a history of resilience. Just remember to pack an umbrella, you never know when it might rain in London. Let's head east to Japan, the land of the rising sun. The Nikkei 225 is Japan's stock market index like the Dow Jones. It includes 225 major companies, from Toyota to Sony and Nintendo. Japan blends tradition with innovation, making the Nikkei 225 a diverse index. It's like a well-crafted bento box, offering a taste of Japan. Now, investing in the Nikkei 225 isn't without its risks. The Japanese economy has faced its fair share of challenges in recent decades, including deflation, a shrinking population, and a strong yen. However, there are also potential rewards for those willing to take on a little risk. For starters, the Japanese government has been implementing various economic reforms aimed at stimulating growth and attracting foreign investment. These reforms, known as Abenomics after former Prime Minister Shinzo Abe, have had mixed results, but they show that the government is serious about revitalizing the economy. Plus, many Japanese companies are sitting on mountains of cash, which they could use to invest in growth, buy back shares, or even increase dividends. And let's not forget about the potential for a weaker yen, which could boost the profits of Japanese exporters and make their products more competitive globally. Think of it like this. Investing in the Nikkei 225 is like buying a vintage Japanese sports car. It might need a little work and some careful handling, but with the right approach, it has the potential to deliver an exhilarating ride. Let's dive into the DAX, Germany's leading stock market index. It represents 40 of the largest German companies. Think of it as Germany's Dow Jones. Major players like Volkswagen, Siemens, and Adidas. The DAX is market capitalization weighted. It has a history of solid growth, reflecting Germany's strong economic fundamentals. Now, like any investment, it's crucial to understand the factors that can influence the DAX's performance. One of the biggest is the German economy itself. Germany is a manufacturing powerhouse, and its exports play a significant role in its economic growth. Any slowdown in global trade or economic uncertainty can impact the DAX. Interest rates set by the European Central Bank are another key factor. Lower interest rates can stimulate borrowing and investment, boosting the DAX, while higher rates can have the opposite effect. Keep a close eye on the ECB's monetary policy decisions and how they might impact the German economy and the DAX. Geopolitical events can also create volatility in the DAX. Remember the European debt crisis a few years back? That had a significant impact on the index. Germany's close ties to the rest of Europe mean that any political or economic instability in the region can spill over into the DAX. And of course, you can't forget about currency fluctuations. The DAX is priced in euros, so if the euro weakens against your home currency, your returns could be impacted. It's essential to consider currency risk when investing internationally, and the DAX is no exception. All right, moving on. Now let's hop over to France and explore the CAC 40, another major player in the European stock market scene. This index tracks 40 of the largest and most actively traded stocks on the Euronext Paris exchange. Formerly known as the Paris Bourse, it's a who's who of French corporate giants. Companies like LVMH, Total Energies, and Sanofi dominate. The CAC 40 is a market capitalization weighted index. It's a key indicator of the French economy. Before diving into the CAC 40, consider a few key factors. France's strong labor laws and social programs can increase business costs. These policies impact corporate profits and the CAC 40's performance. The economy relies on domestic consumption. Watch consumer spending. Monitor economic indicators like consumer confidence and retail sales. Government policy changes can impact the market. Stay informed about major policy changes. The CAC 40 is priced in euros. Watch exchange rates. Fluctuations in the euro's exchange rate can impact returns. Factor in currency risk when investing internationally. Let's head to Hong Kong, home to the Hang Seng Index, or HSI. It tracks the 50 largest companies on the Hong Kong Stock Exchange. Think of it as the S&P 500 of Hong Kong. Many listed companies are Chinese giants like Tencent and Alibaba. The HSI reflects Hong Kong's financial hub status and China's economic rise. Now, before you go all in on the HSI, it's crucial to understand the risks involved. One of the biggest is political risk. Hong Kong has experienced political protests and unrest in recent years, which can create volatility in the market. It's essential to stay informed about the political landscape and how it might impact the HSI. Another risk is regulatory risk. The Chinese government has a significant influence over the economy, and changes in regulations or policies can impact specific sectors and the overall market. Keep an eye on any major policy changes and their potential effects on the HSI. The HSI is also influenced by global economic conditions, particularly China's economic growth. A slowdown in the Chinese economy can impact the HSI, as can trade tensions between China and other countries. It's essential to consider the global economic outlook and its potential impact on the HSI. And of course, we can't forget about currency risk. The HSI is priced in Hong Kong dollars, which are pegged to the US dollar. Fluctuations in the US dollar can impact the HSI's value in your home currency. Always factor in currency risk when investing internationally. Alright guys, let's shift our focus to the east and talk about the Shanghai Composite. This index tracks the performance of all stocks traded on the Shanghai Stock Exchange, which is one of the two main exchanges in mainland China. Now, when you're thinking about the Shanghai Composite, you gotta understand the sheer scale of the Chinese economy. We're talking about the world's second largest economy and a major player on the global stage. This index is heavily influenced by state-owned enterprises, which play a big role in China's economic landscape. Think of sectors like financials, industrials, and materials. These are the heavy hitters in the Chinese market. Now you might be wondering why you should even care about the Shanghai Composite, especially if you're not living in China. Well, here's the thing. China's economic growth has a ripple effect across the globe. When the Chinese economy sneezes, the rest of the world catches a cold. So, keeping an eye on the Shanghai Composite can give you some insights into the overall health of the global economy. Plus, as China continues to open up its financial markets, there are more and more opportunities for international investors to get in on the action. Now, I'll be honest with you, the Shanghai Composite can be a bit of a wild ride. It's known for its volatility, which can make it a bit daunting for some investors. But remember, volatility can also create opportunity. One thing to keep in mind is that the Chinese government has a lot of influence over the market. They've been known to intervene from time to stabilize things or to guide the market in a certain direction. This can create some unique dynamics that you don't see in other markets. Another thing to consider is that the Chinese economy is still developing. This means there's a lot of potential for growth, but it also comes with some risks. You've got to be comfortable with a certain level of uncertainty and be prepared for some ups and downs along the way. But hey, that's the stock market for you, right? It's all about managing risk and finding those opportunities for growth. And with China's growing economic might, the Shanghai Composite is definitely an index that you should have on your radar. Alright, let's go global guys, and talk about the MSCI World Index. This bad boy tracks large and mid-cap companies across 23 developed markets around the world. We're talking about over 1,500 stocks from countries like the US, Japan, the UK, France, Germany, you name it. Now, why should you care about the MSCI World Index? Well, it's all about diversification. Remember, don't put all your eggs in one basket, especially when it comes to investing. The MSCI World Index gives you exposure to a broad range of companies and sectors from all over the world. This kind of global diversification can help to reduce your overall portfolio risk. When one market is down, another one might be up. And by spreading your investments across different regions, you're less exposed to the ups and downs of any single economy. Plus, the MSCI World Index gives you access to some of the biggest and most innovative companies on the planet. We're talking about industry leaders, blue-chip stocks, and companies that are driving global growth. Think about it, guys, the world is becoming more and more interconnected. We're seeing the rise of emerging markets, advancements in technology, and increased global trade. By investing in the MSCI World Index, you're essentially investing in the future of the global economy. Now, I'm not saying that the MSCI World Index is a guaranteed path to riches. Investing always comes with risks, and past performance is not necessarily indicative of future results. But by diversifying your portfolio and gaining exposure to global markets, you're putting yourself in a better position to weather market storms and potentially achieve long-term growth. Plus, there are tons of low-cost index funds and ETFs that track the MSCI World Index. This makes it super easy and affordable for anyone to invest in this globally diversified index. You don't need to be a Wall Street hotshot to get started. So if you're looking to expand your investment horizons and take advantage of the growth potential of the global economy, the MSCI World Index is definitely worth considering. Remember guys, diversification is key, and investing in the MSCI World Index is a great way to diversify your portfolio and potentially boost your returns. Alright, let's dive into the Russell 2000, an index that's all about small cap companies. Now when I say small cap, I'm talking about companies with market capitalizations generally between $300 million and $2 billion. These are the up-and-comers, the businesses with the potential to grow into the next big thing. You see, the Russell 2000 is a fantastic way to tap into that growth potential. These smaller companies can be more agile, more innovative, and often have more room to expand compared to the established giants. Think of it like this: investing in the S&P 500 is like investing in the steady, reliable blue-chip companies, which is great, but the Russell 2000, that's where you find the hidden gems, the companies with the potential to skyrocket in value. Now, of course, with higher potential reward comes higher risk. Small-cap companies can be more volatile, more susceptible to economic downturns. They're not for the faint of heart. But, if you're looking for an opportunity to potentially supercharge your portfolio's growth, the Russell 2000 is definitely worth considering. Remember, diversification is key, and having exposure to different segments of the market, including small caps, can help balance your portfolio for long-term success. Now, how do you actually invest in the Russell 2000? Well, it's actually pretty straightforward. You can invest in index funds or ETFs that track the Russell 2000. These funds will hold a basket of stocks that mirror the index, giving you broad exposure to the small cap market without having to pick and choose individual stocks. Remember, when you invest in an index fund or ETF, you're essentially buying a tiny piece of all the companies in that index. It's a hands-off approach to investing, but it's a powerful one. You're not trying to time the market or pick the next hot stock, you're simply riding the wave of the overall market's growth. And let's not forget about the beauty of compound interest. Over the long term, even small gains can snowball into significant wealth. So even if you're only investing a small amount each month, consistently putting money into the Russell 2000 could potentially lead to impressive returns down the line. Just remember, investing always carries risk. Do your research, understand your risk tolerance, and consider consulting with a financial advisor before making any investment decisions. Now, let's shift gears and head over to Europe, where the Euronext 100 takes center stage. This index tracks the performance of 100 of the largest and most liquid companies listed on Euronext exchanges across Belgium, France, Ireland, the Netherlands, Norway, and Portugal. Think of the Euronext 100 as a who's who of European industry giants. You'll find companies from a wide range of sectors, including healthcare, technology, consumer goods, and financials. This diversification is key because it provides a broad snapshot of the European economy and reduces risk by spreading your investments across different industries. Investing in the Euronext 100 is essentially betting on the continued success and growth of the European economy. It's about tapping into the innovation, the skilled workforce, and the global reach of these European powerhouses. And with the euro being a major global currency, investing in the Euronext 100 can also provide a hedge against currency fluctuations in your portfolio. So why should you care about the Euronext 100? Well, for starters, it offers geographic diversification. If you're heavily invested in the US market, adding some European exposure can help balance your portfolio and potentially reduce your overall risk. Secondly, the Euronext 100 provides access to a unique set of companies that you might not find in other major indexes. It's an opportunity to invest in some of the world's leading brands and companies at the forefront of innovation in their respective industries. And let's not forget about the potential for growth. Europe has a large and diverse economy, and the Euronext 100 reflects that. As these companies continue to innovate, expand globally, and capitalize on emerging trends, investors have the potential to reap the rewards. Remember, investing in international markets like the Euronext 100 can add an extra layer of complexity, so it's essential to do your research, understand the risks involved, and consider consulting with a financial advisor to see if it aligns with your investment goals and risk tolerance. There you have it. We've covered a lot of ground in this video, from the S&P 500 all the way to the Euronext 100. Remember, understanding these key world indexes is crucial for any investor looking to build a diversified and potentially lucrative portfolio.